everybody, so I'm back to the terrible toy makers example here. Again, I apologize that we didn't get through this in class today. Just my timing didn't line up. I was hoping we'd be able to interact, but at least if you guys have practiced this on your own and I can make a video of the solutions. Sorry, you're just listening to me again, but it will be what we can do for now. And next week in our live class, we can go through this balance sheet quickly to start things, and you can let me know if you had any questions then. But let's just go through it. So terrible toy makers have the following balances in their assets and liability accounts at August 31st, 2020. First thing we need to do here is determine if the accounts are assets or if they are liabilities. So if you guys haven't practiced this on your own, the key to you guys really learning this is to practice things. So go through, pause it if you haven't done it on your own yet, go through this, try it out, and then come back to the video. So cash is the first one. Well, actually, before we get to it, remember that assets are economic resources owned by a business that have future benefit. Liabilities are amounts due or payable owed to somebody else. So what we owe at a creditor. So cash, is that an asset or a liability? Right, it is an asset. So we have cash right now. It has a benefit to us. So that is an asset. Accounts payable. Now this is something we still haven't paid to suppliers. It is a liability. Accounts receivable. So remember, this is something we're waiting to collect from our customers, for example. So we still need to receive amounts from those people. That is a benefit to us because when we get that cash in the future, we'll be able to spend it. This is an asset. Inventory. So this is combined of toys that are ready to be sold and the raw materials still to make them. This is also an asset because the benefit is that we'll be able to sell these and make money. Loan payable, due June 2025. It's something we need to pay still, so this is also a liability. So I want to note, you see here accounts payable, loan payable. A lot of liabilities are something we need to pay, but in Chapter 3, we get more into this, and you will see that not all liabilities will say payable. So yes, if it says payable, it's a liability, but there are other things as well. Equipment is an asset. We are using this equipment to build our toys to sell, which makes money, so that's an asset. Salaries payable, again, a liability. And prepaids. So remember, prepaids are something that we have paid in advance, but the benefit we receive won't be till a later time. So prepaid rent is if you pay at the start of a month or maybe for 3 months, you still have that benefit because we get to use that in the future. So prepaids are an asset. Okay, so we've separated out this classification. Now, number 2, we're going to prepare a classified balance sheet. So I talked about in the videos that it's more useful for the users to not just split out assets and liabilities like we've done, but to also further go into current versus long-term. So let's do that next in our assets versus liabilities. Cash. Is it current or long-term? When do we receive the benefit? Within a year or less? Within a year or more period of time. So current, we're going to spend the money. Or the definition for a current asset, assets a company expects to convert to cash, sell, or use up within 1 year. So cash, we have that right now. We have that benefit. It is current. Accounts payable. Now, liabilities on the current side, we plan to settle those or pay them within a year if it's current. Accounts payable, our suppliers expect payment within the year, so this would also be current. Accounts receivable, remember, is the opposite side of accounts payable. So us, as someone who's selling these toys, we also expect to be paid within a year. So this will be current. Inventory, these toys that are already ready, we're expecting to sell them within a year. But we're also only hoping to have enough raw materials that we can produce toys to be sold within the year. So inventory is also a current asset. The loan payable, which is due June 2025, so not for 5 years. So this one is long-term. Long-term liability. Equipment, well, we'll have equipment, hopefully, we expect to, for more than 1 year. We'll have these machines, we'll be able to produce toys for many years. So equipment is also long-term. Salaries payable, well, if any of you guys are employees, pretty sure you expect to be paid right away, so that is current. And prepaids, unless you're given more information, a prepaid will also be current. Company will not be willing to pay, say, 2 years of rent. They're not going to put all that money up front. You would only pay a year or less. So prepaids fall under current assets. Okay, so now we know everything. We know where it's going to fall. We can actually prepare the balance sheet. So here were the ones we prepared in class. We got our balances for the capital. Now we will move on to the balance sheet. So again, we'll name this Terrible Toy Makers. It's the balance sheet. Now, is it for a period of time or at a point in time for the balance sheet? Right, it's at, sorry about that. It is at a point in time. So this one will be at the year end, or you can just say at August 31st, 2020. Because we have all of these balances at the year end date. We're not looking for a period of time, just at a specific point in time. Now I'm going to do this for a breakout. So we're going to do 2020. I do my 2's in different ways. You guys will notice that. 2020 and 2019. What do we start with on the balance sheet? Right, we start with assets. Man, sorry you guys. And we're specifically going to start with our current assets. Look back to your list. What was the first current asset that we noted there? Right, it was cash. And in 2020, we had $14,500. In 2019, $20,200. What was the next current asset we had? Okay, accounts receivable. Right. And it was $11,000 in 2020, $13,800 in 2019. Next, we had our inventory, $30,000, $29,000. Is there any other current assets on our list? Right, the last one we had was prepaids. That was $8,500 and $1,000 in 2019. So multiple current assets. We want to do a total here, or subtotal of current assets. If you add those all up for 2020, we get 64,000, and you actually get the same thing for 2019. Interesting. Okay, so now we need to find any long-term assets that we have, and the only one that we had was equipment. Now, because you've put your total current assets above, it's just assumed that whatever comes next is long-term. So you do not necessarily have to label long-term assets, but if you do, that's not wrong. Again, just a formatting thing, but separating them is required. Naming this part isn't necessary. We've got 21,000 and 26,000. And that was all of the assets that we had. So now we get to our overall of total assets. We add those up, get 85,000 and 90,000 in 2019. So now remember that the balance sheet is based on the accounting equation, which is what? I'm going to assume you guys said it. It's assets equals liabilities plus shareholders' equity. So now that we get to total assets, that's the first half of our balance sheet done. We put our double underline to show that we're done adding anything in there, and we'll move on to the liabilities and equity section. Next on the balance sheet comes our liabilities. And again, for the users, we're going to split out the current liabilities. Okay, so what was the first one on our list there? Right, it was accounts payable. I'm just going to put AP. That's a very common thing that you will see in accounting is AR for accounts receivable, AP for liabilities, so just to shorten it. It was $8,000 and $14,000 in 2019. And the other current liabilities, right, we had salary payable, $6,000 in 2020 and $10,000 in 2019. And that was it for current liabilities. So we come up with our total current liabilities. Which is $14,000 in 2020 and $24,000 in 2019. Whoopsie. That's not what I wanted to do. Sorry, figuring out how to use this. Okay. So we have our total liabilities here. Well, now this isn't working for me. I need another page. Forgive me here. Well, this is where Word, maybe not the best. Let's see if this works for us. Well, I lost that first part, unfortunately. Because of that, I'm going to just quickly, technical difficulties as I'm learning to use this stuff. I'm going to flip back to our Excel that I've got here. One quick second. So same information, now we've just seen it. So we'll get rid of that. So we calculated our total current liabilities. What comes next is our long-term liabilities. The only one we had on the list there was loan payable. So it was due in 2025, so it goes into long-term. And because of that, or after that, we're going to calculate our total liabilities. So we add these two amounts together to get our total, which in 2020 is $34,000 and 2019 is $59,000. So that is our liabilities, but again, the accounting equation, assets equals liabilities plus equity. So next we are going to have our owner's equity. And if we look at our list of accounts that we got for number 3, we're out of accounts. We've used them all. So where do we get our owner's equity from? Well, this is what we calculated in our statement of owner's equity. So in step 2, or number 2, we went through and we created this statement. And this balance here, our end of the year amount, is what we pull into our balance sheet. So if we go back into the balance sheet, we see here we've got Buddy the Elf capital, and we have the $51,000 and $31,000 that we calculated in this statement. So the balance sheet must come third because that is, or we need these amounts to flow from that statement here. So that's all we have in equity. We don't need a subtotal for that since there's only one account. And now we can get to our ending amount of the total liabilities and equity. So we add the $34,051 for 2020 and the $59,000 and $31,000 for 2019, and we get our ending balances. Now, most importantly, it's called the balance sheet because these need to balance. So our total assets must equal our total liabilities plus shareholders' equity, and they do. They balance, so there's no error here. We know that we've picked up all of our accounts, our net income, that's flowed through correctly, the capital's flowed through, and we get here and this balances. So that is great. Now in class, I got the question of why were we separating out the gross margin and why on the income statement did we separate out the gross margin? And I said we were doing that because it provides useful information for the users. So people looking at the statements want to look at that gross margin and use it to make decisions. And that's also the reason why we separate out current assets and current liabilities. So I'm going to just unhide this that I've got calculated. And a ratio that we look at, that in the textbook we will cover it in future chapters, but it's good again to show you guys why are we doing these things, what do users look at, and the current ratio is one of the items that a user will look at to quickly be able to look over the financial statements and assess how well the company is doing. So the current ratio looks at current assets and current liabilities. And it divides current assets by those current liabilities. And it basically is asking or getting to the point of, will the company be able to pay the current liabilities as they become due in the next year? So will they have enough assets to cover off those debts as they become due? So we do the math here. We take our current assets of $64,000 and our current liabilities of $14,000, and we divide those two. So $64,000 divided by $14,000 gets us to 4.57. And this is saying that we have 4.57 times, our assets, current assets, are 4.57 times our current liabilities. Or for every $1 of current liabilities that we need to pay, we have $4.57 of assets to cover that. So you want your current ratio to be at least 1.0, which means you have the same amount of assets as you do liabilities. Anything above that is even safer. So if we have 4.5 times the assets as liabilities, we're very likely to be able to pay off all of these current liabilities as they become due. There's not a lot of risk there. So a higher number is safer. If we look at the numbers for 2019, we take our $64,000 of current assets and then our $24,000 of current liabilities, plug those in, and we get 2.67 times. So again, this number is still above that 1.0, which is our minimum that we want to be at. So we've got 2.6 times the assets to liabilities, or again, $2.67 of assets for every $1 of liabilities that we need to pay. So this is also a strong ratio. It's below the 4.57, but it's still pretty safe. If I have twice the amount of assets than any of my bills that I'm due, I'm still feeling pretty good about that. There's not a lot of risk. So that is just a useful way, looking at the current ratio, it's a useful way to use the information in the balance sheet to assess the position of a company. How well or how likely are they going to be able to pay off their debts? And because we've done this classified balance sheet, where we already separated out total assets and or total current assets and total current liabilities, it's really easy as the user to just pull those numbers out to do these formulas. So that's why we're doing this more of a classification. It's just to give the users more useful information. Okay, again, I'm sorry we didn't get to go through this in class. Take a look over the video. You've done that now. If you have any more questions, you can let me know, either in office hours Tuesday next week, or send me an email. And I'll start class by just looking at this, letting you guys ask me questions on the next week on Thursday as well. Just as a reminder, your My Lab for Chapter 1, if you're feeling ready, you can go ahead and start that. Otherwise, the practice questions are available. And next week, Chapter 2 will open up. So get ready for that. Like I said, it's very important. So you guys want to be paying attention and ready for those videos next week. Okay, have a great weekend.